Good afternoon, ladies and gentlemen. Welcome to the Equals Group PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet Company dashboard. I would now like to hand you over to the executive management team from Equals Group PLC. Ian, Richard, good afternoon, gentlemen.
Hi, welcome everybody. Thanks for dialing in.
Good evening.
Perhaps we could move straight onto the agenda, Richard. So I'm going to run you through today an overview of Equals, some highlights of the first half. Richard will then do a very thorough CFO review. I'll then take you through a bit more detail in terms of what's happened in Q3 to date, and look forward and then summarize from there. So if we could flip the slide again, please. So before I start on this, I was thinking a week or two ago, okay, we got one of these to do, investor roadshow to do. I need to think of something new to say. And it suddenly dawned on me that actually I don't have to think of something new to say, that it's a good thing that we set out what we were intending to do back in March when we did the full year results roadshow, and we've executed against that plan. And so to some extent, it's as you should expect. We have talked the last couple of years about pivots from B2C to B2B, pivot more towards platform away from product. Solutions was a brand new thing in May 2021. This has a refreshing sense of familiarity about it. So I don't need to spend 20 minutes at the beginning trying to explain everything that we do, because hopefully by now most of you will understand it. So this slide is a rehash of what I've gone through before, in that we have the three major products of accounts or current accounts, you want to think of it like that, underpinned by the own name multi-currency IBANs. We have the ability to do cards, both debit and prepaid. And we can do payments, so account-to-account payments, be they FX or indeed same currency. You take those products, we've got some differentiating factors to our competition. And by the way, no one company really has everything that we have, so it's hard to identify a direct competitor. But we have the platform that combines both payment and cards. We have a lot of connectivity we've built up over the last few years and will continue to do. So we go direct where possible, removes people from the supply chain, makes things quicker, easier, more reliable. We invest a lot into compliance. We view that as a strategic asset, not as an overhead. And whilst we have a lot of the tech that fintechs have, they are generally self-serve. You can't talk to a human. We have great customer service capabilities, as you can see from Trustpilot scores, and we will take our customers through the journey and explain stuff as we go, rather than pure self-serve. You take all of that, you get the platform that you're all aware of, unified, highly configurable, highly flexible. We sell it to SMEs via the Equals Money brand, and to larger corporates or enterprises, it's the Equals Solutions brand. And that's where we are. The next slide, again, slight rehash, but I put a lick of paint on it, so I've got nice new colors here. You can see where Equals was in 2007 when we started up as a B2C card business on that bottom left, through our journey to kind of where we are now, where some of the people we're citing as competitors, are pure payments as a service or banking as a service providers like Modular or Clearbank, for instance, or Railsr shouldn't be on there because it kind of almost disappeared. But that journey is well told and well understood, I think. Could flip the slide, Richard, please. And here, again, something we had last time, but gives a clear representation as what Equals can do in terms of the capabilities on the right-hand side, versus some of the competitors you might think of. And without going through every tick and cross there, you can see that what we're capable of compared to others stands out, and especially when you look at our market capitalization or enterprise value compared to some of the others on there. So what we have is something that we have built carefully and in a controlled manner over the last 5 years that has massive functionality, outstrips our peers, but relative to them, we look undervalued. So I think that's a fair investment case right there. Flip the slide, please, Richard. So in terms of some factual things that we did in H1, we obviously did a lot. As you can see, transactions and revenues both grew at 43% clip, which means we maintained our overall margins. But EBITDA grew way quicker, as we all know, and that's through increased gross profit percentage and everything cascading down ultimately to profits, which is fantastic. Richard will take you through that in far more detail shortly. The platform itself, we now have, and it's a super important sign in the road, full API functionality available to customers. What does that mean? It means that rather than having to log into Equals Money, if a large customer wants to connect their system directly to ours, so-called host-to-host, they can do so via what's called an API protocol. Takes time to integrate, as you might expect, but those customers tend to be bigger, and obviously they're very sticky if they're going to go through that process. I'll talk a bit more about that later on. We've also increased the automation of the payments out journey. We automated payments in first, payments out. Like a massive percentage of our payments out now are automated, and that will be completed during the balance of this year. European expansion, we acquired Equals Money Europe, which used to be called Unex, and we got regulatory clearance actually just outside of H1. It was on July the 4th. Again, we'll talk about that a little bit more in a second. On cards, we've now re-platformed FairFX, so it's on new tech, not old. We can decommission the old. Partly the timing of that, for those of you long memories, Wirecard fell over 3 years ago, and so the cards we issued at that time, because we had to, are all expiring. So it's the perfect time to do that shift over to new tech. So that's really the last major thing that we have that's running on old platforms. The API integration of cards also means we can now start to offer this as a white label. We integrated Rocket that we bought earlier this year, or completed earlier this year. So if you load your FairFX cards, you'll be presented with an option to load it via Rocket. It's very funky. Any of you have a card, please use it and you'll see what I mean. And we've integrated into Xero as an accounting package, and we'll be doing more of those as the year progresses. On sales and marketing, we've deployed far more of a regional sales model. We're a great believer here, especially when you're selling to corporates and especially larger corporates. Get out on the road, see people face to face. Don't expect everybody to come to London or just because you're in London. That doesn't work as well as actually being out where they congregate. So we have more people traveling, going to trade shows, conferences, that type of thing. We've also radically improved our digital real estate, so our pay-per-click, SEO, websites themselves, all way better and converting way better. And we're actually marketing the whole concept of multi-currency IBAN properly now. We have web pages that support it rather than just outbound sales. And compliance, constant theme, continued investment into personnel. It's largely, rather than being an increase in headcount there, it's a sort of scale up of quality. So we've been improving who we hire in, especially to the enhanced due diligence teams, more experienced compliance professionals there. We're also now using Featurespace, which I've mentioned before, which is a AI-enabled transaction monitoring system. If we're onboarding quicker, you can't just onboard and then forget. You have to monitor. It's a vital part of the compliance puzzle. So it's great that that's live. Next slide, please, Richard. Just a little bit on Equals Money Europe, Unex as was. I'm sure there's interest in knowing what's going on there. As I mentioned, we completed the acquisition on the 4th of July. We renamed it on the 9th of August. We have a properly incorporated local board there with non-exec directors who are local. I am actually on the board, as is Richard, so we have representation there, but it's important for the regulator that it's run as a proper subsidiary standalone entity. And we submitted a plan to the NBB, National Bank of Belgium, that's the regulator. This was always part of the plan with them. Change of control comes first. We submit the strategic plan to them second. That's not holding us up in any way. The feedback from them on that plan so far has been extremely positive. It's actually a document I'd love to share with everybody at some stage. It's a really good piece of work. Sometimes these plans can actually help you, distill your own thoughts. So it's been a great exercise to do for them. Recruitment, we've made some key hires. Head of finance is in place, head of risk. Interesting there, the head of risk won't just do risk in Equals Money Europe, but will service the group as well. And another thing the regulator likes and I like is that this entity is part of Equals Group. It's not a complete standalone. So if we find a great person there, they can contribute into activity in the group elsewhere, and that's to be encouraged. So we're continuing to hire. We've taken much better offices there, put the staff in the offices. The atmosphere amongst the staff, we've kind of equalsified it, if that's a word even. So the offices feel like this one does that I'm sat in right now. They attend every 2 weeks we do an all hands. We've had them all over recently to meet everyone that works here. So I'm very pleased with the pace at which we've managed to do that. Products integration, whilst we could pretty much go very, very quickly in terms of putting solutions through that entity, we can only go at the pace of the banks. We have to integrate with them. That takes a while. We have ING and KBC that already had relationships with that entity when we bought it. We're also adding Citigroup and Barclays into the mix, into the entity. So we plan to do that in the balance of this year. We're still on plan for that, if anything, slightly ahead. So, and the same with Equals Money. So hence why I said earlier that submitting the strategic plan hasn't slowed anything up, because by the time we get the approval from the MBB on all of that, is when we'll be ready to push more volume through the entity anyway. At that point, I'll hand over to Richard to take you through some numbers in more detail.
Thank you, Ian. And the slides that I'm going to take you through really augment quite considerable disclosures in both the front and back end of the RNS. But before I do so, I think it's just quite useful to remind some people who may be new to the stock that we are a tech-led financial services business regulated by the FCA, the Bank of England, and now additionally by the National Bank of Belgium. And that recent acquisition has given us 2 additional banking links with ING, and KBC, which augment what we have with Citibank, Barclays, and NatWest RBS Group. And just as a sort of elevator pitch on our numbers before I take you through the slides, we are unusual in that as a financial services company, we are fast growing, and we've got more than double-digit growth in revenue, considerably more in the year-on-year comparison. We have had a gross margin improvement. We've had an even better drop through to our P&L, an even better drop through to our earnings per share, and an equally good drop through into cash, which has allowed us to have plenty of bandwidth for M&A, market shocks, and hopefully the announcement formally of a dividend in due course. So I will now take you through those slides in turn. So just a snapshot of our P&L account, and you can see the growth in the right-hand margins, revenue up 33% year on year, 17% up on the second half last year. There's not very much seasonality in our business apart from a bit in the retail. Our gross profit margin, our gross profits have increased but our margin has also increased, and that is just as important. It has always been our aim to punch through the 20% EBITDA margin, and we've done so in this first half. We don't have very much non-cash going through the P&L these days. We do have a tax charge now, but there is a difference between the tax charge, the reported tax charge, and what we will be paying in tax, because we have 13.4 million of losses carry forward. We do have some tax payments to make in relation to one small but very, very important subsidiary, our white label business. That has all led to a real turnaround in our reported earnings per share. I would stress that these are reported earnings per share figures, not adjusted earnings per share figures. And for those who are very technically minded, we've got a paragraph or so in our RNS just reminding people how earnings per share is calculated, which is not, as you may think, earnings just divided by shares. There are all sorts of fancy fair value calculations for the diluted. I'm going to lead completely on to cash flow, not least because I've mentioned the word dividend, and cash seldom lies, and we wanted to illustrate this again, and this follows on from many of our disclosures that we've done before. So, what do we have that isn't through the P&L account? Well, we will continue to invest, and we will continue to capitalize a portion of our staff costs. There's not much working capital movement. It can be, it can move weekly, our working capital, depending on the day of the week that is at month end. It can depend on when some of our customers have forward contracts that mature, etc., etc. We don't have any debt. That's all been completely repaid well over 6 months ago. We have some acquisition cash flow outflows, and there's a slide on that later on, and we're quite proud to make the acquisitions that we have made in the period. So we've ended the period with almost 18 million of cash. 2 slides on revenue, one in pictures, which shows very clearly that the SME business in international payments and cards is growing very, very well. But the star of the show is solutions. It is now 30% of revenue. We believe that may well get to 50% within a year or so, probably 2025. But the white label business has continued to grow. The consumer business, which is really the only, it represents less than 5% of our business now. A massive turnaround from when we started this journey, that has grown certainly year on year. A slight dip on the second half of last year, but nothing to worry about. And this excludes our bureau business that we sold in the first quarter of this year. This next slide is a simple bridge. How have our revenues moved? So you can see there's the best part of 14 million of increase in revenues in a single half, and 53% of that revenue increase has come through solutions. And if you do the math and you look at H2 2022 and the comparison, again, some 59% of the increase over the last second half of last year, again, comes from solutions. But again, both the graph and this numerical slide shows that we have increased the revenue from SMEs against a tough economic background, and ditto from white label too. But our gross profits have also moved up, not just in margin, but in quantum. And so what this slide attempts to demonstrate is the areas where the margin has increased. I'll pick a simple extract. Total international payments, we've got a 41% gross profit margin that is diluted really by the white label business, but the gross profit increased by 2.2 million. And where did that increase come from? So we're saying here that in the aggregate, something like 75% of the gross profit increase came from the increase in revenue, but 25% came from improved efficiencies in or lower cost ratio. And the bullets along the side of the slide give more of a story in that. Our cost of sales are threefold. They are transaction cost, affiliate commissions, and staff commissions. And they're very, very, very variable with revenue. And the dial that we can move most is actually affiliate costs. Ian's done an amazing job in renegotiating with some affiliates lower terms, because some of those affiliates are generating a lot of business for us, and they're doing very, very well, and good luck to them. And affiliates are often the key to getting into new market segments too. So where do we spend our money? Well, there are no great surprises in this slide, but again, for transparency, we're just putting it up on one page. If you look at the bottom of the slide, you'll see that our headcount year on year has increased by 21%, but actually our staff costs have only increased by 18%. So we have hired very, very wisely, and it's a testament to the success of our share option plan or share incentive plan and our LTIPs, that no one really that we have wanted to keep has left. It's been a fantastic retention tool.
I'm still here.
And that really puts pay to that. And those staff costs include, recruitment, training. Training is a really big budget now for us to stay ahead of all the compliance rules, the consumer duty, etc. And for those who have managed to read through our RNS, you will see that there's a little bit of nuggetive information there relating to how much performance-related pay is as a percentage of our total staff cost. And the answer now is 25%. So we have really de-risked a lot of the staff costs as well. Moving on to the EPS increase. And really the point of this slide is just to show that, the denominator in EPS has moved a bit, but it's moved such a small amount that it's had the tiniest impact on our EPS calculation. The rest is pretty straightforward. It's the revenue, the gross profit dropping through to everything else. So investments and acquisitions. There are two slides here. One is based upon what we did in the period, and the second slide is what we've done after the period. So those who have followed us for a while will recognize that we continue to make investments through our fantastic tech team. And most of that investment has gone into Equals Money, the platform, and Boxes is a sort of subset of that platform for the launch of further products, particularly for solutions. And then the second part is, what have we bought externally? And we've announced that we bought Rocket, an open banking platform, at the beginning of the year. We announced that we did a small FX brokerage business called Hamer and Hamer, and both of them are really adding to our product and revenue set now. And after the period, Unex, now renamed Equals Money Europe, acquired on the 4th of July, an equity deal with some working capital components that will over time get repaid. We're injecting that by way of loans, so it doesn't pose a dividend trap for the business, and it means that they can be repaid as Equals Money Europe gets into profitability. We will continue with product development in the same sort of quantum as we've been doing in the first half of the year. And in the second half of the year, we do have some outflows in relation to our very successful acquisition of Casco. And Hamer and Hamer, this FX business that amazingly had an incredible day today, can get a further 1.7 million over 3 years if the targets are met. And there's also some money to go out in relation to Rocket. I thought we'd sort of end with this slide, which is, we're quite often asked, how much working capital do you need? What happens with it, etc., etc. So we have the money at the banks, primarily, Citibank, Barclays, and NatWest. And of that, just under 10% is probably sort of trapped. There is a regulatory deposit of just under 400,000, but the rest is, float that we need. We have a card provider where we pre-fund, and if you look further down the page, you'll see that there's another card balance there. So our card business consumes about 1.4 million of working capital. We margin our clients as best we can, and we are margined by our liquidity providers all for forwards. And so there was 2.1 million of margin at the balance sheet date that was consumed there. The rest is, as you'd expect for any other trading business. And out of that 14.2 that we're showing here, 5 million is my rainy day money. I think 5 million is the amount of money I would never want to go below. And so I think that is quite important in thinking about, how we can reserve money for future acquisitions, and how we can, should the board decide, formally declare a dividend when the court process has concluded. So I'll now pass back to Ian to talk about our current trading and the future.
Thank you, Richard. Could you flip the slide? Thank you. I won't go through this in exhaustive detail, but far right column there is 2023 year to date. If you look at the revenues per working day, how they've continued to go up. When you look at Q3 to date, we're running at about 30% higher than Q3 last year, which is a very healthy increase. It was quite bizarre. Those of you who followed us for a while will know that last year I was really wanting to do 70 million for the full year. We did 69.7, and we were very close to being 40% for that bottom right hand number, and it came out 39.45 or something like that. So I keep missing my big figures. But the period we picked for this year was pretty much the same as for last year, so September the 8th. And the first few days of September last year, we had quite sort of supernormal days. So we picked a really tough period to compare ourselves to. The message is, we continue to trade well and strongly, and growth is robust. And as I alluded to in the RNS, when I look at the future in terms of pipeline, this is it's strong. So we are encouraged. As we integrate more and more into larger enterprises via API, there is a lead time with that. It can take months rather than weeks. But obviously they're chunkier revenues when they do come on stream. So I have good line of sight as to where we ought to be going in terms of our revenues for the rest of the year. Flip the slide, please, Richard. This somewhat ugly slide, but nevertheless gets the message across. Think of it now that we have one tech stack, equals core. It's the platform, all the settlement rails, the direct connectivity, the licenses, compliance, the operations, the factory, if you want to think of it that way. And we have one API layer, and that API layer supports our own products. So equals money, Card One Money, FairFX now, all consume from that central core via that API. And it's the same API that we will serve up to third parties. So when we'd had this chat a year ago, we only had those top three boxes there, equals money, Card One Money, and FairFX. We didn't have the ability to integrate with third parties via APIs or white label them. Now we do. And what this is trying to get across, therefore, is the addressable market for us just gone a lot bigger. Just in that, by having the API capabilities that we are really reaping the benefits of now. And we'll see more white labels being done by us during the rest of the year. On top of that, we've got geographic expansion. We already had the UK, obviously. It's where we basically all our revenues have come from up to now. Europe will be coming on stream, as we know, and you heard earlier. We have a route into the US. We've not pushed our accelerator hard on that yet, and neither will do so until, you don't want to be stretched going Europe and US both at the same time or committing a load of resource. Our US headcount is the grand total of 2, and we'll stay that way for the foreseeable future, but we have the route into there when we choose. And obviously there's other geographic places we could go to. The beauty of this model now is it could be that other countries, whilst we could go there, we'd rather not and let somebody who is already there, utilize our tech via the API links and consume it that way. So we don't necessarily have to sell it through our own brands. I think that's the message. So it's far more platform driven, far more fee-based driven as we move forwards over time. Slide, Richard. So we'll continue to grow, and we'll grow with control. That's the overall message. So as we look forward on payments, we'll fully automate all outbound payments, basically by the end of this year. Bulk payments is a pet thing of mine. That is allowing a customer to send thousands of payments by one click of a button. They can do dozens or maybe 100 or so now relatively easily, but it's we can't industrialize it, and so that will open up global payroll and all sorts of other types of solutions, and they'll be able to do that either via API or by logging into the platform, doing it that way. And we will continue to go direct where we can. One piece of this is to take out third-party interfaces into Swift and do it all ourselves directly. But there's other direct payment network integrations I'd like to be doing over the course of the coming months and years. On cards and acquiring, we can now decommission the old platform. Thank you very much. B2B cards in Europe and the US, as we've mentioned. White label cards are coming via API links. We've got a couple of large ones in play currently. And enhance the Rocket platform to process euros. Right now it's sterling only. Equals Money Europe, we've submitted the plan to the MBB. We'll launch the multi-currency IBANs. We know we have demand for this product, both with existing customers and customers that would like to use us but can't and have said so. Integrate with the new banking partners and also plumb in Citi and Barclays, as I mentioned, and grow the current merchant acquiring offering, which is actually performing ahead of plan currently. Sales and marketing, we won't defocus on SMEs, but we'll do more focus on the larger corporates because now we have the API capabilities, we can do so. We will continue to upgrade our salespeople as we do in the compliance area. We need smarter people. We're not selling on price. We're selling on functionality. We're solving problems. So you need salespeople that are capable of doing that. We'll continue to expand and improve the digital reach, including some social. A big fan of face-to-face sales, so attending conferences, trade fairs, limited sponsorship also. We'll come into that. So get people to congregate where you can sell to them or go where they congregate. Compliance and risk, obviously we'll continue to invest there, experienced professionals, quite often with particular industry expertise, different industries have different nuances and it's good to have people that understand how they work. Increased use of the transaction monitoring, utilizing AI. And we know that regulators, not just the FCA, but the world over, it's more and more about protecting the consumer. We have consumer duty regs coming in here any minute. That's a theme just as well with B2B then, isn't it? But even on B2B, you do still have to watch what you're doing. And I think it's worth emphasizing the strength and depth that we have. 5 years ago or even less, it was a bit lopsided. There was a lot of reliance on me personally. We've got a good quality exec team that's fully populated, and the layer beneath them is also very good. And overall, our workforce is our strength. The SIP and LTIP regimes that were put in place and supported by shareholders. So thank you for that. Have been instrumental, I think, in staff retention. Think about it, we people on, in customer services, maybe on £25,000 a year, now own, £8,000 to £10,000 worth of stock. It's a material amount, which they'd lose if they leave. So they're engaged. We've got a great culture here, motivated workforce. Could flip the slide, please, Richard. So in summary, Equals, as I say, it's very much delivering on the message that we said we would do 6 months ago, and if anything, we've outperformed it. Continued growth in all the key metrics: turnover, revenue, profits, distributable reserves, which I could never say properly. And we're trading ahead of expectations, which is great. Throwing off a lot of cash. Active in M&A, as you've heard, 10p a share just in the cash that sits on the balance sheet. The core functionality, the product functionality that we have, the Equals core powering everything, and now we have the API layer and that one platform doing cards and own name IBANs, as we all know. It's not unique, but it's still quite hard to find. The tech is scalable. We commissioned, because we've been talking about our tech for some time, we commissioned an external company to do an audit, if you will, of our tech and make sure that what we were saying is correct. It's a very positive audit that I've got back from them. That 10x capacity is from that report, not me pulling a number out of the sky. So we're proud of our tech, and ISO 27001 is in flight, should land this year. Basically, that's a sort of best practice badge of cyber security and security in general. So we're very proud as and when we get that. Compliance culture has been a theme throughout the deck and throughout the last couple of years. We'll continue to increase the headcount there and skills. Everyone, and I mean everyone, has to do compulsory training, which lands at least one new module every month, actually normally 2 or 3. We have independent audits to make sure we're on track. And as we know, the FCA are hot on the sector. And last but by no means least, the company is now grown up enough to pay this has an intention to pay the maiden dividend, subject to all the various stuff that we have to do that. And I think that is a key statement. What we're not saying is, okay, our growth has peaked, let's start paying dividends. We're saying we're confident, very confident in the business, such that we can pay a dividend and still have enough cash to do what we need to do to drive the business going forwards. So on that note, we'll hand over to do the Q&A.
Ian, Richard, that's great. And thank you very much indeed for your presentation today. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Richard, Ian, as you can see, we have received a number of questions throughout your presentation. And Ian, if I may just ask you just to make your way through the questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thanks. And as we know, due to time constraint, we might not be able to answer all of them, but I'll do my best. Some we've answered during the course of the presentation. So the first question is, solutions has gone to 0% of revenues to 30%. What percentage of revenues do you expect it to represent over the mid to long term? Well, the most immediate, I think, Richard, you covered this, that we expect it to get to 50% of revenues probably by, it might happen next year, but more likely sometime during 2025. And I think that's a reasonable expectation. The next question is there seasonality in the business with some months consistently stronger, weaker than others? And if so, why? The answer is yes. In that, because we're so much of a B2B business now, and obviously on the B2C side we still have that seasonality for travel, but it's a very small amount of our total revenues now. But B2B customers tend to be quieter during holiday months. So July, August are typically quieter than other months. This month is typically strong. The last 10 days of December are typically a graveyard. So, but it should all come out in the wash. The next question, at what point would you consider a main market listing? I think the honest answer is we always consider a main market listing. I think we're too small to do that. Of course, we could buy other businesses and get our market cap up that way, or, hopefully the share price will do what it ought to do. I think it becomes more of a thing when you're at 250 million market cap or more, that it's something you can consider. Equally, AIM does have its advantages, not least inheritance tax funds. Alpha have stated an intention to move to main market. So there's some arguments to say you should stay on AIM, but something we'll constantly review, and I think it's a very fair question. The next question is, how likely are you to do share buybacks, assuming required votes to allow these? Personally, I'd like to see this. It's another really good question. I think the dividend announcement and moving distributable reserves up to Topco so that we can pay the dividend also frees us up to do that. I think it would be easier to say we would definitely do that if the stock was very liquid and had a big free float. My concern will be taking out shares from a liquidity standpoint, but I'll take advice on that. Part of me would like to do it. Some shareholders would like us to buy back shares that match any LTIP or SIP awards, and I get the logic of that. So I can't give a definitive answer, but I take the input. Next question, Q3 revenues per day, slightly higher than those in Q2. Delighted to see that, as I would expect it, yes. They are stronger than in Q2, and we maintain, as you can see, that the revenues per day number continues to tick up for the whole year. So clearly revenues per day in Q3 to date are higher than they were in Q2 and obviously in Q1. So do I expect a stronger finish in the year now the business is ramping up for Q4? Yes, but always that caveat of December. So I think the numbers that analysts have put out today are sensible. Most of them are predicting around 20 million of EBITDA. And if you think Unex is probably dragging about 1 million, so that would be 21 million of EBITDA if we hadn't done Unex this year and start to contribute next year. So I'm confident with the numbers we have out there. Of course, it's possible to beat them, but I think that would be premature to say so. The next question is, do I have any thoughts on Alpha's acquisition of Cobase? Are Alpha replicating equals here, i.e. our Alpha Group direct competitor equals in Europe with acquisition of Cobase? No, actually we looked at Cobase ourselves. It's a very good business. What it is a treasury management system, really. So it's not like an Unex. It's a platform that, if you're a corporate with 700 bank accounts across 10 banks, you can look at all in one place and manage it from there. It's pretty cool, pretty funky. I was talking to an investor earlier, and I said, well, if we were speaking to that corporate, we'd say, well, get rid of those 10 banks and just have one account with us. We do everything for you. That would simplify it rather than using that platform. We will butt heads with Alpha a bit more than we have in the past, but I think the big difference between us and them is we have invested in prior years way more into the plumbing end of it, if you want to think of it that way. We don't normally take wallet off each other. It's certainly not happening yet. We're normally taking wallet share off banks. So we're not in a direct head-on competition yet. And even if we were, the market scale and the addressable market is so big that there's definitely room for the both of us. The next question is, are you able to give any further guidance on dividend policy? The short answer is not yet. What we wanted to make sure we did now was state the intent to pay, and the strong dividend cover that we have there, 1.5p. Richard will quote a statistic that we're basically adding 6p a year at current rates in cash to the balance sheet. So it's only a quarter going out in dividend that we've announced an intention to pay. It'll take a little bit of time to get this through EGM and the court process. And so when we hopefully formally announce the dividend, we'll clarify the policy a bit more then. I think it'd be a little bit premature now, but we certainly aren't expecting to pay less in future years. Let's put it that way.
Yeah, and for those who are shareholders, you will be getting a circular tomorrow, and it'll be going up with the various proxy forms on our website too.
Great. Next question. Have you started earning revenue in the US? If not, when do you think this will start? And going forward, what do you see the revenue split between UK, Europe, US? Great question. Not really. I mean, we have customers in the US that we do international payments for, but I'd really ascribe them to the UK business. We have soft pedaled launching the card in the US. The banks there have been slow, but it's kind of suited us because we're got our hands full with the European expansion. I would say, next year with a following win on UNEX, I'm not sure what numbers the market consensus is, around 115 million, isn't it? Something like that, or 113. We might do 10 to 15 in Europe, US, maybe only one, but that'll change over time. If we get the traction we expect in the US, I can see the US picking up quite quickly, but I don't really want to predict more than a year out. So the key now is nail Europe and expand there, because we know that will work. We've got a pent-up demand there that's going to move the needle quicker than committing a lot of resource into the United States. The next question, are you aspiring to ramp the European solutions business faster than the UK equivalent, given there's existing demand for Europe from the current customer base? Yes and no. I mean, the devil's in the detail and the execution. It's possible. I just don't know until we're in it. Even if we just replicated what we did in the UK, I think we'd be happy with that. I think investors would be happy with that. When you look back at the numbers of what we managed to do, there's a fair argument to say we could and should do it quicker than that, given what we know and given that the systems are all bedded in. But I'm not going to commit to it. Richard, here's one for you. Could you explain a little bit about the RNS regarding the share premium account? I agree, it is very legally is wording, so any deciphering, Richard, you can give would be helpful.
Yeah, yes. If you look at a balance sheet of a company or a group like ours, there'll be the group and then there'll be the company in its own right. It is a company in its own right that has to have distributable reserves to be able to pay a dividend, not the group. And we have very substantial share premium. We have 53 million in our share premium account. And all we're doing, if you follow a little bit of accounting theory, is we're going to go debit share premium, credit distributable reserves, 25 million. The bottom half of the balance sheet doesn't move. The top half of the balance sheet doesn't move. It's just an inter-account transfer. But it does allow us through the court, so it's court approved, to pay a dividend, buy back shares, whatever.
Very clear. I mean, unfortunately, that's the legal wording, and I agree. When you read something that says capital reduction, you go, "Oh, what the hell's that?" But it's not a bad thing; it's a good thing. And the last question / comment, it's a very kind one. Great business update. Thank you for spending time talking to small investors. Please keep doing so when you are much bigger. Yes, we will. I actually quite enjoy this, or I wouldn't be doing it at 6 o'clock on the first day of the roadshow. That's the end of the questions.
Ian, Richard, absolutely. And thank you very much indeed for being so generous of your time then addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately afterwards, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the Investor Meet Company platform. But Ian, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Thank you. Yes. Well, I think as I mentioned at the beginning of the presentation, what's good about this set of numbers is we've delivered what we said we would do, and it's a consistent story. Now it's about adding more distribution channels for the business. We're not doing anything radical or, oh, by the way, we've now thought of this new thing to do. It's executing on a plan, and it's clear that the plan is working. Add into that continued growth in Q3, add into that the maiden intention to pay the maiden dividend. And I think you can see that the company has evolved and grown up, continues to be a growth story that we can all be proud of. You've got a workforce here that's absolutely committed to it. It's loving doing what they're doing. So I think it's a great investment case. And I would like to thank those of you who are holders for being holders, and those of you who are not, I would encourage you to become one. And thank you all for your time this evening. Thank you very much.
Ian, that's great. And Richard as well, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Equals Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good evening to you all.